Investors Chronicle.
Welcome to the Companies and Markets Show. It's Thursday, the 13th of July, as we record. I am a bit croaky today due to spending too much time talking in a noisy room yesterday evening, but we are going to persevere nonetheless. Coming up on today's show, we look at full-year figures from insolvency specialist Begbies Traynor and ponder what they tell us about the health of the company and indeed the health or otherwise of the UK economy. Then we turn to our cover feature this week, which is all about investment in the North Sea, an increasingly controversial topic, but I think there's no doubt its energy output is still of major interest. Whether that production is based on oil, gas or wind power is, of course, a different question, and one we are going to discuss later on. After that, we will turn to the raft of announcements made this week regarding UK pension schemes and market structure, some high profile, some less so, and we'll ask whether they can achieve their goals of reinvigorating UK company investment. Joining me to discuss all of this are over the line Mark Robinson.
Hi, Dan.
And in the studio, Alex Newman. Hi, Alex.
Hi, Dan. I was going to say your vocal fry, only lends an authority.
Good. I'm glad. Yeah. Some much needed.
Don't worry about it.
Much needed authority.
On this investment life.
Indeed. Alex Hamer.
Hey.
And Leonora Walters.
Hi.
As I say, Begbies Traynor then, Mark. You covered the annual results out earlier this week. How did they look? I did
with a certain degree of glee as well. On the face of it, though, they were pretty positive. We had a 17% increase in adjusted operating profit. The underlying margin was heading in the right direction too, and management made great store of the fact that they boosted free cash flow, even though they paid there was an overall increase in dividend payments as well. So, on the face of it, they were a decent set of results, but I think it's the underlying story, really, which is probably of more interest to our listeners.
Yeah, we will come on to that very shortly, of course, but it's probably worth spending a little bit of time talking about the business itself to begin with. One thing we should say first up is that insolvency isn't the only string to its bow. It does have, fairly big other aspects to the business, which has been growing and acquiring businesses in those areas too.
Yeah, I made the point that it's been rising year on year as well, and I think revenues from that non-insolvency work, they account for about 40% of the group total, and management was also keen to point out that they've got pretty healthy rates of recurring revenue, and by that they're not referring to individual customers themselves, but the types of business they're finding they're getting more and more volumes through. So those kind of things they can that might relate to like corporate finance, and that's buy and sell support on corporate transactions. You would imagine that would be slightly down at the moment, but they've also got a strong financial advisory team there as well. And when you think about it, the company as a whole is used to seeing the strains, the economic strains on individual companies. So they're probably in a pretty good place, you would imagine, to advise on corporate stress as well. And that can apply to debt advisory and pensions advisory also, links to financial restructuring and forensic accounting as well. So it's quite broad based. They've also got a growing property consultancy, and they cover a lot of different areas there. Commercial property management, that's obviously a hot topic at the moment anyway, but also things like proprietary risk management there, and specialist insurance too. They're an acquisitive company obviously, and they bought 3 chartered surveyors during the period under review as well, which will obviously feed into that consultancy. So yeah, that's a bigger part of the business. But part of the reason I was interested in looking at them this time around was because obviously we've seen increased weakness in the UK economy.
Well, what kind of weakness are we seeing, or do their results suggest we are seeing?
Even ahead of time, I was looking at a recent government report which pointed out that the level of insolvencies in England and Wales had increased by 40% in the year through to May. It may be, I mean, this is pure speculation, but interest rates have been on the rise now for about a year and a half. And it could be that, the negative impact that is only just becoming apparent. There's an inherent lag between interest rate pressure and economic performance. And plus you've had during that period as well, it's an inflationary environment and wage inflation is also picking up quite dramatically. And there's a bit of a lag there until that comes through. So companies might be under more stress now than they were a year ago or even 6 months ago. And that's why the figures, we may be at a tipping point. Who can say? Also, before I was covering the results as well, I just was looking at some of the recent economic surveys and business surveys, in particular the Institute of Directors, their economic confidence index, and looked at it since the beginning of the year, and it's been sort of oscillating quite wildly as well, which suggests that there's a degree of anxiety in the economy. It doesn't seem that business leaders are necessarily completely downcast on prospects, but there's a great deal of uncertainty. So, it's for that reason itself, I would imagine that conditions on the face of it have improved for insolvency practitioners and in fact, their special advice arm as well.
There is this question about, with all parts of the economy now, isn't there, with interest rate transmission mechanisms and how long they take to feed through. Obviously, the mortgage housing market is a big aspect of that, but also, this side of things too, because to me, it does seem the economy is still, perhaps more resistant than we might have thought, even at this stage, notwithstanding that delayed transmission. I think when Begbies say themselves, when it comes to administrations of big companies, they're still below pre-pandemic levels they were in the last 12 months, which, given rates are much higher even in that period, is maybe slightly surprising.
Yeah, I mean, that's why I say, perhaps we are at a point now where we're going to start seeing a little bit more weakness. But your point is exactly right. The economy has seemed far more resilient than most commentators had been expecting as well.
Yeah. Onto Begbies itself, Alex, I'll bring you in now, Alex Newman, just because I know you were looking at this earlier. I mean, the shares are down 6% over the past year, despite, they raised guidance a couple of months ago, and obviously the narrative of, higher interest rates equal more insolvencies is, quite compelling. I mean, does that, relatively, pretty poor share price performance in the context, very much in line with the market, does that just underline that it's actually quite difficult to make money from a narrative, even if it seems plausible on the surface? Or are there other reasons why they may have underperformed?
Yeah, it's an interesting one. I mean, that it's sort of just as insolvency work looks like it's about to hit a real purple patch. The market's kind of a little bit quiet on the story, despite it being actually a brilliant long-term holding for investors. So, sort of over 10 years, the share price return has compounded at nearly 15%. And if you reinvested dividends that have been steadily improving year on year since 2017, that jumps to 19% compound return. So it's like really one of the leaders across the London market. Now things look like this is where you'd expect Begbies to perform, and there's been the drift, as you said. I mean, there's a couple of reasons which might explain it. I think there's a perennial thing with Begbies Traynor's shares, which it's easy to confuse matters, is that their reported profits and their net margin always looks very, very thin, because they've got sort of decent-ish margins, as Mark alluded to, at the gross level. Even when you add in other costs and sort of paying staff, and these, aren't always cheap people to employ, professional services people, you've still got a decent adjusted operating profit of about £22 million for the most recent financial year. The rub after that is the investments in the business, and they have, the reason they've been a good long-term holding is that they've been very canny in the way they've bought up smaller businesses and integrated them. But it always does depress statutory profits, even though it's been improving free cash flow over the long term. I think maybe one thing investors are considering, potential bear point now, is that this inorganic growth, which we've seen in recent years, requires, or it's now going to require greater scale purchases to sort of move the needle. And there's probably an awareness among the selling principals of firms that might get bought that we are now in a boom market for restructuring work and insolvencies. So they might be commanding a higher multiple. In other words, it might be getting more expensive for Begbies to grow in the way they have been growing, because just the nature of their market is improving. So it's kind of contradictory in that sense, that things are looking better, but that might mean it's getting a bit harder for them to deliver for shareholders.
Yeah, I mean, I had a look at the net margin actually just before we came on, and that it is rather thin, 2.4%, and for a consultancy that seems desperately low. That's more in line with the supermarkets themselves. But on the point about the M&A as well, they've got the high transaction costs this time around. They accounted for 7% of overall revenues, and the amortization charge as well, arising from those acquisitions, is another 6%, which goes some way to explaining why that margin is so thin.
I think as well it's maybe interesting to consider competition, not least in the insolvency area, where, again, this is like many growth markets you expect, again, this is a big opportunity, but often it depends on, what other people are doing in that market and how many people are interested in that market. And, Begbies themselves, I think, it's a breakdown in their figures, their presentation, the nature of that market. And it's quite interesting for me to see, that actually there's still a large proportion of, this business is being done by lots of regional, small, local firms. So on one level, might not cost that much to hoover up a load of them, at least in terms of how much you pay, if not how much the financing costs. But on another level, it's a very fragmented market, and they are the biggest players.
It is odd just how volatile their shares have been, though. And Alex points out over the long term they've been a good investment. There's no doubt about it at all. But Michael Taylor, in a previous piece he's done on them, has pointed out the fact that the volatility of the share price is at odds with the company's fundamentals, and it's quite true as well. And I had a look recent history as well, and when you looked at the short-term average, that moved above, or dipped below rather, the 200-day moving average back in March, which provides a negative symbol, the death cross, rather ominously. And since then, the share price did fall away, but those averages have started to coalesce now, and it's come back up. But it is quite strange just how volatile the shares have been, even though those moves have been fairly short in duration.
Well, let's turn now to our cover feature this week, which, as I say, is on the North Sea. Alex Hamer, our news editor, you have written this piece. What is it about? We kind of know what it's about. B, the big question: what is the future of the North Sea? I guess is what everyone is increasingly asking, if they ever stopped asking it.
Yeah, I just have to stop reeling from the technical analysis there by Mark. Just highly impressive. So the North Sea's in a funny spot right now. Obviously, everyone has been thinking very hard about how the UK can keep the lights on, basically. And through that, the answer is we need a fairly good supply of gas. Renewables are good because we don't have to buy things after we've paid to build them. But when the wind slows down, what are we doing? And at the same time, there's this sense from the public, reflected in policies from the government, that how dare these oil and gas companies make huge profits from the North Sea while we're struggling to pay the bills further down the supply chain. So you've got all this thrown in together at the same time as, there is obviously still the idea that we probably don't want to destroy the planet in a few decades. And then how do we...
Probably don't want to do that, yeah.
Yeah, no. Yeah. Ideally, no. And then how do we put all that into an energy system that is rapidly changing, no matter the actions of a handful of energy companies who, just the little bit of context there is Shell and BP have said in recent months that they will focus on what they're good at, which is extracting oil and gas, and part of that comes from investor pressure, and they look at the valuations of the North American majors. And so what happens if these huge cash-rich companies aren't spending massively on green projects? But that's a side issue. I guess what I wanted to look at with this feature was, as an investor, how do you benefit from this changing landscape in the North Sea? And it's tricky. I mean, right now, the UK has dropped or is in a position where its oil and gas production is far lower than it was 20 years ago. It's far lower than it was 10 years ago, and yet we've also had a lot of optimization, to use a jargony word. I mean, you've got companies in the North Sea that mid caps who are using more efficient extractive techniques. They know what they're doing. They've worked on these wells for many years, and they are making a lot of profits, even though the government is taking a bigger chunk than it was 2 years ago. And obviously prices have fallen, but they're still pretty good. So you've got companies paying good dividends with an outlook that it might not be as positive. I mean, we're probably not going to get to 2022, late 2021 levels of profits again anytime soon. But there are fairly chunky dividends to get as an investor. The longer term view, outside of that immediate shareholder returns, is the North Sea will continue to grow as a renewable energy hotspot. We saw BP this week put up billions and billions of euros to have the right to develop 2 separate wind farms offshore in the North Sea in German territory. That slightly goes against what I just said about them pulling away from the investment, but they're identifying projects that will make the money, and this seems to be one of those. So, as an investor, how do you position yourself? Obviously, that's a whole lot of information, and I'm sure writing it down, it's a lot clearer. So please read the story. But it's quite a sticky one, really.
Yeah. Well, we'll come back to wind in a minute, but just on oil and gas and on the windfall tax, the energy profits levy, which you were talking about, companies, as is their wont, obviously, have complained about this quite vociferously. There has now been a price floor introduced in a bid to, I think the government has always been trying at least to encourage investment at the same time as, taking a higher tax take. So what's your assessment of how that tax has affected things, if at all? Does that change kind of the short, medium term prospects for these companies?
I think there are 3 companies that show the impact of this quite well. There's Harbour Energy, which came to the London market 2 or 3 years ago through Premier Oil, and they're a huge producer, the biggest independent producer in the North Sea. They have pulled planned spending from last year and this year. They've laid off 350 people from their North Sea teams, and they are actively shifting that spending elsewhere, Gulf of Mexico, and so they are fully highly reactive to the higher tax, and that's because they were probably more open to it. More exposed to it, even though they're carrying big tax losses. I think their capital spending was not high enough to balance it out, really. So big impact there. You've got a company like Ithaca Energy, which is the controlling shareholder of the Cambo oil field. They also have a stake in Rosebank, which is similarly an undeveloped oil field that is oil and gas field that is being put through the development process. They're waiting on government sign-off, but for Cambo, they need to finance it, and they've found their lending situation has deteriorated this year, and therefore they've pushed back their final investment decision. They're currently marketing Shell's stake in the project, to use their lingo, and they want to do that before they commit to expanding it further, or to developing it further. So they are also heavily impacted by this tax. If you look at a company like Serica Energy, which is smaller and basically got itself into a really healthy balance sheet, consistent production by this quite canny deal they did where they bought a handful of in production assets basically, and then but they financed it through a shifting cash flow sharing deal with BP, I think. So they basically ended up, as prices were shooting up, with full access to that cash flow. So a really good balance sheet. And they've in December last year they joined another company, or they bought out another company called Tailwind. So they've increased their reserve space, significantly over the last 2 years, and they're also really keen to spend, so they can actually offset some of that tax hit. So yes, their share price is weak. They haven't lost the 50% of their market cap like Harbour has in the past year, but they're probably down 20 to 30%. They're making slightly less big decisions. They're funding kind of near field development. They're putting in I guess you call them infill wells. That's kind of they're spending, £10 million on something instead of £200 million on something. They would like to, commit to big field level work, but they don't feel like it's the right environment. But they're still doing fine. So there's a range of impacts, and the big thing that everyone kept saying though was we don't like the uncertainty. We're trying to plan to spend money on things that will make us money for 10, 20 years, and we can't do that right now.
In some ways, just a final point on the government policy side of things, perhaps there is certainty. That's not a contradiction in terms, insofar as some of these some of the big projects, small projects, be they Cambo, Rosebank, or something smaller. Labour have said if they get into power, which they may well do next year, according to current polling, that they won't allow any new licences. So there is potentially a hard deadline there to get these projects through before that time, which might, it's a strange and probably unwanted form of certainty and unusual, but there is that potential deadline coming up as well. Yeah,
for sure. And I think, the other side of this coin is, talk to an energy investor about the North Sea as an investment destination. And he says, obviously the uncertainty is really bad, but the North Sea itself, if you want big new fields, you're not looking at the North Sea anyway. So there's places where you can, Guyana's a hot spot right now. People still really like the Gulf of Mexico. There's spots that really will have that growth, and it's probably not going to be in the North Sea. The tax hasn't helped if you want more domestic oil and gas production, but it's not like it's fully killed things off. It's a bit more, it's a bit grayer than perhaps Harbour is putting it.
Sure. Well, what about wind? The big potential and big growth area. That said, a lot of the wind producers as well have their own complaints about the government, or certainly about policy and the direction of that. What are those kind of issues, and also how can investors, access these kind of opportunities in the UK?
It's a really interesting space. I think the mad rush for wind was seen as probably 2 to 3 years ago, when these huge sums were being spent on access to. The big Crown Estate one that we all potentially know about was the Irish Sea, not the North Sea, but it's the same vibe. Committing billions to have these offshore development rights. For investors now, though, the question is how much do you? Once again, we go to the outlook and certainty, but how much do you back the EU, for example? There's a North Sea Compact where they want to massively increase offshore development between, it's the Dutch government's into it, Germans are into it, Danish government's in it, the UK is in it. That's from a couple of months ago. They want to massively ramp up the capacity of the North Sea. And, I guess this German license, or this German auction we've seen BP put cash into, or commit to, this week is a sign that, things are moving. If you look at the equities involved, there's kind of Ørsted and not much else, really. Ørsted is developing its Hornsea 2 and 3 projects right now, which are huge wind farms in the North Sea in UK territory. And it's happening, basically. they've spent the money, they've got the permitting. That's one way in. They're obviously quite bullish on the region because there are those drivers through the EU and others really backing those. If you talk to, there's one person who works in the kind of stop oil space, and for her, the idea that you wouldn't just put everything into, from an energy security point of view, put everything into renewables is silly, basically, because it means once you have this infrastructure, that's your energy supply. And as we shift away, the way that the energy companies put it is we're shifting from, joules to electrons. And so you have a more electron-based energy system where far less gas is used domestically than, renewables is the whole game. Obviously, cutting the demand for gas is not easy. Her response to that was basically they've managed to do it in, Scandinavia, the Nordics. Even Italy is cutting its gas usage massively, and they're buying EVs, and they're still managing to cook pasta without a gas cooktop in a lot of new builds. But that's kind of, she was like, we'll work it out, don't worry about it. So I think on an investment front, with all that as context, there are funds available, not massively North Sea exposed, but if you want that kind of growth approach as opposed to fairly big dividend yields right now, that is probably the way to go. There's obviously lots of questions. I think one thing that came out was everyone thinks there's going to be a lot more decommissioning spending. There's so many rigs out there, there's so many wells out there that do need work. The government will probably end up footing a bit of the bill, but you look at the growth prospects in terms of that area. I spoke to Wood Group, they're pretty keen on decommissioning. You look at a company like Petrofac, they've got, contracts on this coming out the wazoo. I think that's a pretty reliable one. And obviously those services companies do rely on new oil and gas and I guess, operational contracts for oil and gas as well as renewables for income. But they're also exposed to decommissioning. Unfortunately, there's no decommissioning pure play listed that I could find, but,
Maybe one day, as decommissioning is increasing inevitably, that will.
Yeah, I'll be back on the pod pitching my decommissioning, decommissioning PLC in a year
that you're setting up. Yeah, there you go. Thank you, Alex. That is the cover story this week, as we say, and there is a complex topic, so do pick that up and have a look if it's one that interests you. To finish, though, we are going to turn to the big policy announcement of the week, or the big set of policy announcements, starting, Leonora, personal finance editor, with the most high profile, or certainly the one that's garnered the headlines, which is DC pensions investing in unlisted assets. This has been trailed for a while, but the government and Jeremy Hunt in the Mansion House speech this week came out with some concrete plans on what they're going to do.
Yes, 9 of the largest defined contribution pension schemes, which manage over 2/3 of UK defined contribution workplace pensions, have committed to allocating at least 5% of their default funds to unlisted equities by 2030. So that could well be, you or me or, quite a lot of employees out there. The 9 providers in question are Aviva Scottish Widows, Legal & General, Aegon, Phoenix, Nest, Smart Pension, M&G and Mercer, and they've signed what is known as the Mansion House Compact. Now, the Chancellor has made a number of claims as to, the reasons for doing this. Possibly even spurious claims. He says, for example, this could result in up to 50 billion of investment going into high-growth companies by 2030. And perhaps even more fantastic, the Chancellor claims that this move and a number of other measures he set out on Monday and Tuesday could result in the average earner having over £1,000 more a year in retirement income due to the size of their pension pot increasing by 12% over the course of their career. Sounds grand, doesn't it?
It does. Obviously, that I think it's fair to say is unknowable and untestable.
Yes.
But who knows? It may do. But this is the 5% of these schemes, default funds, will be in unlisted equities by 2030. There are some caveats to that insofar as if we look at the tangential or related goal of boosting interest in UK companies, one of which being that these unlisted assets don't necessarily need to be in unlisted UK companies.
They might be in the UK, they might be abroad, we just don't know. But just as an example, private equity returns over the past 15 years have benefited from very low cost of capital when financing via debt. But obviously this is no longer the case. It's no longer cheap. So they're not going to be able to get cheap finance and profit as much as they used to. And the point about investing pensions in private equity is it costs more than just putting pensions, say, into bonds or listed equities, and higher costs, as we all know, when you invest, eat into returns. So, that's one reason why this great return might not happen. The other point about the UK growth boost is that they say 50 billion, of investment will go into unquoted companies. Well, that's only if the rest of the DC pension market follows suit. And they might well not. I mean, for example, XPS Pensions, a consultant, did a flash poll on Tuesday after this was put out. It found that only about 30% of pension scheme representatives are broadly supportive of the Chancellor's plans to encourage pension schemes to invest in this way. So there's not exactly great enthusiasm, for going into these assets.
There were some other announcements as well this week. We'll come on to some of the market structure ones in a minute. But on the pension side of things, a value for money framework is also being looked at. I think in terms of the idea here seems to be that, as you say, costs can eat into investment returns. This is more perhaps going the other way to an extent, and it seems to be what they're driving at, i.e. that despite the fact that costs can eat into returns, it doesn't mean you should exclude expensive assets from your portfolio, because therefore you may miss out by doing so. You may miss out on higher returns. That seems to be maybe what they're driving at with this value for money framework, even though it sounds like the opposite.
The government's done a consultation on this, and it's value for money, looking at metric standards and disclosure. And the findings include that government says you should put an emphasis on value rather than cost. And obviously the reason for that is, or one of the reasons for that is because they want to invest more in private equity, which costs more to invest in. The government also said, oh yes, we're going to look at long-term performance too. Okay, but costs eat into long-term performance. And what they're going to do, among other things, to help assess if a scheme is good value for money, is going to introduce, I think, a standard set of metrics and standards, so people can compare them off against each other. I was going to say, in terms of other things they've launched this week, they've launched a consultation on how to address the issue of investors accumulating many small pension pots of different employees over the course of a career, which I think a lot of us do. Basically what it's proposing is automatic consolidation, whereby I think they haven't thrashed out the fine details yet. They're consulting on it. Basically, if you move on, the pot you left behind, it'll get moved into one of a few consolidated companies, along with whatever other pots you leave behind. And because they're quite large, it'll be scale, good value for money, and it's going to be literally a few select companies that have been carefully vetted to do this.
I think consolidation of pension pots and pension schemes is a theme of some of these reforms, because they do want to also consolidate pension schemes so that they become bigger pools of capital in some cases, albeit that is some way off from happening. Alex, you were interested in some of the points around market structure that have been announced this week, specifically one of them on this idea of an intermittent trading venue for unlisted companies.
Yeah, I'm interested. Doesn't mean I know what it is, really.
No, well, it's new. It's brand new, isn't it? No one's quite sure yet.
They haven't said what it is, to be honest. But
understandably, it's sort of buried beneath the the pension reforms, given how important addressing that challenge is. But the So this intermittent trading venue, as they call, which is promises to build a new kind of exchange that no other exchange has done before. The idea of it is to give private companies access to public capital markets without having to go through the listing process. So it's an interesting idea in that we're trying to work out new ways of supporting growth and innovation for the parts of the economy which don't have ready access to capital markets. Obviously, there's huge questions over this, even though the LSE is, supposedly working on it, and Jeremy Hunt said, expect this by the end of next year. There are obviously going to be trade-offs here. Governance is one thing you look for when you're listing in a public market, and checks on the way that your money is invested and managed. And then I suppose on the other side you've got holding periods, and when is it private, when is it public? Are there going to be in these intermittent trading windows opportunities to buy and sell? But I mean, I think it's really something to watch. I mean, particularly for retail investors or our listeners who ways that they might be able to participate either directly or indirectly through whatever funds might get set up on the back of this. But I thought it was an interesting development, and I'm quite keen to see what the details here that are going to kind of please all parties.
Do we think any of these reforms could amount to something significant in terms of, the big question on this topic is, will they work? Will they achieve their desired aim of, reigniting the fire underneath the UK economy, the UK as an investment market?
Yeah, it's a hard question to say, but I think, if to give a slightly contrary view on the Mansion, House announcement this week, we really need to do something. Long term for pensioners, it's a positive that we're thinking about improving their long term returns, because if not a cliff edge, then we're certainly going to get into sort of long term funding deficits further down the line. And then there is obviously the economic impetus behind all of this to sort of facilitate more of a growth economy, more of a kind of, I suppose the comparison is always going to be with America and their, very business-friendly environment. We've got loads of great, technology and biotechnology and science expertise in this country. And I suppose the idea is to try and harness this and connect it more to financial markets. That's probably a good thing, I'd argue. And the question of risk, it's all unknowable. It's all very hard to, I think both make the kind of promises Jeremy Hunt has done, but at the same time, it's important, I suppose, to look at the ways risk can be spread out over decades, which pensions are there to do. So it's an attempt to address a really, really tough set of problems, but I think it's good we're, collectively trying to do this.
On that optimistic note, we have come to the end of the show, so thank you very much to everyone. Thank you to Leonora. Thank you to both Alexes. Thank you to Mark. And thank you to you for listening. We will be back next week with another Companies and Market Show.